This is the Alhambra Investments Weekly Market Pulse, where we try to bring some clarity to things that went on the previous week. One of the big discussions last week was about Bitcoin and cryptocurrency. And Joe Calhoun, are you ready to take a victory lap?
No, we don't really do victory laps here. Look, we tried to warn people that there was a lot of speculative excess in that market, but there's still people in there who have made a lot of money on this thing, and still people who have money at risk. And so we don't do victory laps. But I'm glad to see some of the froth come out of there because I think it has an impact on the way people view markets more generally. So I'm kind of glad to see it come off the boil.
Well, another issue last week, we started to see some doubt maybe about the post-virus boom, and you saw a slight change in the direction, the expectations for inflation and growth.
Yeah, that expectation of a post-virus boom had become consensus. It had just become common knowledge. Everybody was expecting that, and I think there's some reasons why maybe it's not happening the way people envisioned. We're seeing some supply constraints, obviously, in some sectors, automobiles and housing, for instance. I think it's also a matter of I believe that people will be more conservative with their money once we get through to the other side of this thing. That would be the typical response you would see to some type of crisis. It certainly happened after 2008, um, which is a little bit of kind of weird to say that when there's so much speculation going on in the markets because people aren't acting very conservatively. But as I said in the piece, I think people are kind of working with house money at this point because they got all these payments over the last year from the government. I think people don't see that money the same way as they would money that they earned themselves. But anyway, we did start to see a little bit of a change last week, and I don't know if it means anything yet. It's very small. But we did see nominal bond yields, the 10-year Treasury note yield fell a couple of basis points, while the 10-year tip yield went up by about 9 basis points. So that gives us a drop in inflation expectations and a slight rise in real growth expectations. That's the direction we want to go. But I think it's a little bit surprising, probably for a lot of people, that inflation expectations actually fell last week. And like I said, it's small. It doesn't mean anything yet. We'll see if that continues and see how that continues to go. With the copper to gold ratio pulling back the way it is, though, I kind of expect that you're going to continue to see nominal bond yields at least flat, maybe down a little bit if the copper to gold ratio continues to fall. So it really will depend on what happens on the real side, what happens to tips yields, what happens to real yields. If those start to rise, then we could start to see some better growth expectations, real growth expectations at a lower inflation rate, and that would be good. But we're not there yet.
Well, you talked about copper to gold. What do you see in gold in particular and commodities in general?
Well, I think we're at a little bit of a turning point here. I think people got a little too optimistic about the general commodity complex, particularly in the agricultural space where large speculators are just long everywhere. Corn, soybeans, it doesn't matter. If it's grown, they're long. So I think there's probably, those guys are probably a little too far over their ski tips, and I think general commodities probably can pull back here. Plus, we do have China announcing various times over the last week, and I think even again last night, that they are going to crack down on some of the commodity speculation going on over there. And they're certainly reducing the amount of new credit being created, so that has an impact on these markets as well. Gold, on the other hand, has been rising pretty strongly over the last month, up about 6%. That's an interesting thing because you had tips, the gold was up last week while tips yields were up too. That's not what you normally see. You normally see tips yields and gold moving; they're inversely correlated. So when tips yields fall, gold tends to go up. So kind of a weird thing there. But I think this is about the dollar, and we are very close, I think, to a breakdown in the dollar. And by the way, I send a piece. I look through these futures markets. I'm always looking for extreme positioning because when you get extremes, they get corrected, and when they get corrected, they can often move pretty quickly. There are no extremes in the currency markets. Everybody's pretty neutral. If we had a bunch of people short the dollar, I'd say, this thing's probably not going to carry through to the downside because these shorts will have to cover. But that's not the case right now, and it seems as if they want to push the dollar lower. And we're close to a technical point where if you break it, I think you're going to see a lot of selling. So That could be what's driving gold. I'm not sure, but certainly it is kind of another indication that the growth expectations are not that great. People don't buy gold when growth expectations are good because they'd rather invest in something that provides them with a real return. And gold doesn't really do that.
Flesh out a couple of statements that you made in the report. You said the recovery's not over and that there's really no renewed recession that you see.
Yeah, I mean, we have certain things that we watch to kind of help us guide us to the onset of recession. We don't see any of those things right now. So what I'm talking about, in a sense, here is that we're seeing a peak in the rate of change for inflation expectations, and really what we're talking about is nominal growth. So we're looking at a peak in nominal growth expectations here. Um, but that doesn't mean that we're about to head down and go into recession. It doesn't mean that we're about to have some new crisis. It doesn't mean any of those things. It just means that we're passing the peak rate of change. And I think really the peak rate of change in this case is not as high as people thought it would be. And because of that, I think you're probably going to see some correction in markets to reflect this new reality that we're not going to get this boom. Or if we do get some kind of boom, it's going to be spread out over a longer period of time. But no, we don't see anything that points to recession right now, just a peak in the rate of change.
And do you expect anything big this week, or is it going to be fairly quiet going into Memorial Day weekend?
I don't know if it's ever quiet in these markets, Bob, but we do have some pretty important reports coming out this week. We had a durable goods report, and it'll be interesting to see the capital goods portion of that report. We also will get a personal income and personal spending report. Now, the personal income report on the surface is going to look really bad. Because remember, we had in the last report was up 21% or whatever it was. That included stimulus payments, which we won't get this time. So personal income is going to look down a lot month to month, but year over year, it's still in good shape. So I think the more interesting number will probably be personal consumption and see how people are really spending their money. We'll see if this idea of a kind of a peak in the rate of change is maybe shows up in that personal consumption report.
All right, Joe, thanks for the insight.